Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Institutional market briefing, macro data, Nasdaq 100 rebalancing, and SpaceX IPO mechanics. This video presents a direct informational narration of the source document. So, looking at the close of the trading week, the market's focus has been heavily, and I mean heavily concentrated, on the highly anticipated SpaceX IPO. We're actually seeing overall market trading volume contract quite a bit, with capital acting like a magnet drawn straight toward the space sector. And as a result, that sector experienced a really sharp pullback, erasing almost all of the previous day's gains.
Here is the roadmap for today's explainer. We'll be moving systematically through 6 key areas. First up, macroeconomic updates. Second, the Nasdaq 100 rebalancing. Third, we'll dive into stock profiles and technicals. Fourth, the SpaceX IPO trading data. Fifth, the SpaceX lockup schedule. And we'll wrap it all up with institutional positioning data.
All right, part 1, macroeconomic updates, specifically focusing on oil pricing and consumer sentiment. Let's kick things off with the geopolitical landscape in the Middle East, because it's having a direct impact on energy markets. Based on recent reports, it looks like the United States and Iran are closer than ever to hammering out a peace agreement. The Prime Minister of Pakistan, who's been acting as a mediator here, confirmed that both sides have actually agreed on the final text of the agreement and are working closely on the next steps. Both the US and Iran have told the mediator they're ready. Because of this, international oil prices have continued to slide, dropping 2.6% to hit $86 a barrel. Now, dropping below that $90 threshold is a pretty big deal. It tells us the Strait of Hormuz crisis is largely factored out by the market right now. Unless we see prices spike back up to $100 or more, which would obviously signal things are deteriorating again, the capital markets are reflecting this overall easing of tensions. Capital flows, as always, remain the most accurate indicator of what's really going on geopolitically.
Shifting gears to the U.S. economy, we've got the preliminary June survey from the University of Michigan, and it's showing some really significant improvement over May. The Consumer Sentiment Index jumped from 44.8 up to 48.9. That comfortably beats the estimated 46 and actually breaks right through the upper limit of the forecast range. But maybe even more interesting are the inflation expectations, which saw some notable drops. The one-year inflation expectation ticked down from 4.8% to 4.6%, and the 5-year expectation dropped quite substantially, from 3.9% down to 3.4%. Both of those figures are coming in considerably lower than what was expected.
Moving right along to Section 2, the Nasdaq 100 rebalancing. Let's look at the additions and deletions.
So, the Nasdaq 100 index is scheduled for a rebalance effective June 22nd. They are booting out 5 companies and bringing 5 new ones in. The 5 tickers getting removed are CHTR, CTSH, INM, VRSK, and CS. CS in particular has been dealing with slowing growth and some sustained earnings setbacks lately. On the flip side, the 5 new kids on the block are ALAB, CRWV, NBIS, RKLB, and TER. What's really interesting here is the sector breakdown. 4 out of these 5 additions are tied directly to semiconductors and artificial intelligence infrastructure, while RKLB operates in the space sector. This totally aligns with the Index Committee's standard playbook. They strip out the companies with slowing growth and replace them with high-growth players in the hottest current sectors. It structurally adjusts the whole index's forward earnings expectations.
Section 3. Stock profiles and technicals for these new NDX additions.
We're going to break down the fundamentals and technical levels for these 5 new Nasdaq 100 additions, going straight from the source data. Just a heads up, several of these stocks have pretty sky-high valuations right now, or they're currently operating at a loss, so we're presenting these metrics for direct reference. First up is ALAB. With a price hovering around $367, its forward price-to-earnings ratio is a steep 125 times for 2026 and 94 times for 2027. But look at the growth. EPS is projected to jump 58% in 2026 and 33% in 2027, giving it a 5-year compound annual growth rate, or CAGR, of a very healthy 41%. On the technical side, ALAB is a highly volatile stock, which creates these wide support zones. Right now, support sits between $334 and $350, and again at $304 to $325. If it breaks below $304, there's a bit of an air pocket until you hit strong support way down between $226 and $241.
Second is CRWV. Priced at roughly $100, this company is actually projected to operate at a loss for both 2026 and 2027. EPS growth looks like negative 105% for 2026 before bouncing to positive 82% in 2027.
Its 5-year CAGR, though, a very solid 56%. Looking at the charts, CRWV is currently trading in a pretty narrow range. You've got dense support from 99.2 up to 107. If we see a breakdown below 74.5, that would definitely signal a bearish technical shift. On the upside, overhead resistance is strong between 120 and 124, and then again from 131 up to 143.
Third on the list is NBIS, trading right near 232. Consensus data projects it'll also be operating at a loss for both 2026 and 2027. EPS growth rates are sitting at -3% in 2026, pivoting to positive 82% in 2027. Technically speaking, there's support between 209 and 232, with lower safety nets at 156 to 167 and then 125 to 134. Overhead resistance here is actually relatively light, sitting between 259 and 267.
Coming in fourth, we've got RKLB. You can kind of view this one as an alternative asset play in the space sector. It's priced near 102, and yep, it's also expected to post losses in 2026 and 2027. However, the EPS growth is strong, positive 55% and positive 75% for those respective years. Technical support is a bit weak right underneath it between 95.8 and 100, but there are stronger support zones established lower down at 82.4 to 92.2 and 64.3 to 74.3. If it pushes up, it'll hit strong resistance between 124 and 133.
And finally, we have TIER. Now, out of all the new additions, TIER easily presents the most fundamentally stable profile. At a price of 403, its forward PE is 56 times for 2026 and 43 times for 2027. EPS growth is projected at a massive 79% in 2026 and 31% in 2027, driving a 5-year CAGR of 34%. Technically, TIER is looking pretty clear, with no immediate overhead resistance. Support is well established between 338 and 386, but keep an eye on 293. If it breaks down below that level, the next really strong support is pretty far away, way down between 214 and 233.
All right, Section 4, SpaceX IPO trading data, looking specifically at volume and valuation.
So, let's shift our focus over to the initial trading data and the underlying structural mechanics of this massively anticipated SpaceX IPO. The core metrics here are just staggering. The initial pricing was set at $135. The offering raised $75 billion, which immediately brought the company's market capitalization to an eye-watering $1.77 trillion. Total shares, 13.076 billion. But here is the critical part. The floating shares issued amount only 556 million. That represents a microscopic 4.25% of the total shares. On its first day of trading, the stock opened at $150, hit a high of $176.52, and finally closed at $160.95. That's a 19.22% jump right out of the gate based on that $135 IPO price.
Because of that incredibly low float, the volume numbers were wild. The first day's trading volume reached a massive $84.6 billion. To put that into perspective, it resulted in an extreme turnover rate of 93.76%. Basically, nearly the entirety of those 556 million floating shares changed hands during a single session. It's a clear indicator of massive intraday speculation, rapid share rotation, and just highly frequent repeat transactions by the market participants. Looking down the road, there are some structural market shifts coming for the stock. Options trading could potentially begin as early as June 16th. Now, when you mix options trading with an extremely low float like this, you introduce a very real risk for gamma squeezes. If strike prices get set close to the market price and open interest concentrates heavily, market makers might actually be forced to buy the underlying stock just to delta hedge their exposure. On top of that, the stock is slated for fast-tracked inclusion into the Nasdaq 100 index, which is expected roughly 15 trading days post-IPO, so right around July 6th.
Moving into Section 5, the SpaceX lockup schedule and those all-important institutional release dates.
So one of the most critical factors impacting the stock's ongoing low float status is the institutional lockup expiration schedule. And this timeline is strictly defined. The very first release is going to happen right after the Q2 earnings report, which we expect around August. That will release up to 20% of the locked shares, with an additional 10% released if certain price performance metrics are met. Following that, you've got fixed incremental releases of 7% each at 70, 90, 105, 120, and 135 days out. Then, after the Q3 earnings report, expected around November, an additional 28% hits the market. Finally, at the 180-day mark, which puts us in mid-December 2026, 100% of the restricted shares will be completely released. But the big takeaway here? That float is going to remain extremely restricted for at least the next 2 months.
Finally, Section 6, Institutional Positioning Data, looking at JP Morgan and CTA triggers.
To wrap up today's explainer, let's look at the latest institutional positioning data derived from JP Morgan's prime brokerage, as well as CTA trend following parameters. The newest data from JP Morgan shows us a complete trend reversal in hedge fund positioning. Back in May, the data showed strong, persistent upside buying and a lot of long accumulation. But in June, global long-short net leverage dropped sharply to a 12-month low, basically coming back down near its 5-year average. This sudden reversal was primarily driven by heavy long selling over in the North American region. It tells us there was a really sudden reduction in bullish exposure by these institutional funds.
Complementing that fundamental shift, we've also got specific CTA trend-following support levels to watch. For these algorithmic strategies, buying tends to remain pretty light during upward movement, but the selling accelerates rapidly if specific downside thresholds get broken. Based on the data, the primary programmatic sell triggers are defined at breakdowns below 73.12, 70.26, and 66.05. If the market breaches those levels, it's going to activate some accelerated institutional selling protocols.
So, what does this all mean? With institutional net leverage dropping so sharply from its May highs, and these precise CTA sell triggers clearly defined to the downside, the mechanical structure of the market is definitely shifting right now. The big open question remains, how are these underlying technical positioning dynamics going to interact with the upcoming liquidity events, specifically that sequential expansion of the SpaceX float over the coming months? Based on everything in this source data, it's clear we are heading into a highly complex structural environment moving forward.